Scroll through financial media today, and you are hit with a barrage of anxiety. Warnings about bursting AI bubbles, imminent economic slowdowns, and Federal Reserve missteps dominate the feed. But what happens when an investor filters out that emotional turbulence? You expose what market professionals call a dislocation. Over the summer, retail traders aggressively sold off positions in technology and industrials, reacting heavily to technical panics and frightening headlines, rather than changes in actual business performance. Institutional strategists operate differently. At firms like JP Morgan, the chief investment strategy completely ignores daily sentiment. Instead, their models rely entirely on strict, verifiable data to dictate where capital should flow. Separating that daily market noise from economic reality requires a highly specific filter. Strategists use a three-factor analytical framework to grade the actual health of the market. Relying on this three-factor institutional framework replaces panic with mathematics, providing a structural method to navigate and profit from modern volatility. The first factor is the most objective: positive earnings. While daily headlines insisted that tech stocks were crashing and that a mass rotation out of the sector was necessary, the internal accounting told the exact opposite story. This bar chart compares recent earnings revisions across specific sectors against the negative volume of the market sell-off. During the worst-performing weeks for stock prices, the actual earnings revisions for technology, industrials, and communication services were entirely positive. Look at the massive divergence here. Prices were dropping while earnings expectations were rising. Across institutional strategy, positive earnings growth is widely considered the single most reliable reason to buy into a sector. The underlying businesses in these categories were securing larger contracts and generating more cash flow, a reality completely detached from the daily fluctuations of their stock tickers. When businesses produce higher cash flows while their retail share prices drop, the math points in one direction. It is a definitive signal to accumulate shares, completely invalidating the emotional urge to sell. The second factor is capital efficiency. A persistent retail fear is that heavy corporate borrowing, combined with prolonged high interest rates, will eventually cause massive companies to buckle under the debt load. To understand why that hasn't happened, you have to look at corporate leverage. The average public company carries about 2 turns of leverage to finance its operations. The companies driving the modern tech sector carry only about half of that debt burden. Microsoft is the prime example of this anomaly. Operating with roughly 1 turn of leverage, the company is so thoroughly insulated from borrowing costs that it currently holds a higher credit rating than the United States government itself. This efficiency extends beyond Silicon Valley. Traditional banks and financial institutions are uniquely positioned to turn these exact same macroeconomic conditions to their advantage. Operating in a strictly regulated environment, top financial firms deploy their capital through a highly efficient dual strategy. They utilize high rates to maximize returns on loan growth, while simultaneously executing some of the most aggressive share buyback programs in the market. Holding immense cash reserves and actively reducing share counts acts as an institutional shock absorber. It ensures these companies generate value regardless of broader market anxiety. The third factor expands the timeline: long-term macro catalysts. The financial press dedicates countless hours analyzing every single statement emerging from the Federal Reserve, treating each meeting as a make-or-break moment for the economy. But short-term central bank maneuvers, like highly anticipated rate hikes, are often executed simply from maintaining institutional credibility. They are moves to prove the Fed retains control, not reactions to alarming underlying economic data. The true macroeconomic signal driving the market is the shift from software adoption into a hardware-intensive infrastructure cycle. We are seeing corporations build the physical backbone, from fiber optics to data centers, required to support artificial intelligence. Strategists model this as a structural cycle with a 10 to 15-year runway, mirroring the long-term capital expenditure patterns seen in the build-out of the early internet. Capital is currently being poured into the initial, heavy lifting phase. The massive backlogs in corporate spending are entirely focused on the fundamental building blocks: advanced semiconductors, physical cloud architecture, and cybersecurity. Focusing on a single month's interest rate decision obscures this 15-year structural shift in how businesses are being fundamentally retooled for productivity. When you align these 3 factors, rising positive earnings, highly efficient capital structures, and long-term infrastructure spending, the chaotic fear of the daily market vanishes. You are left with a clear mathematical equation. This line graph plots current market expectations, which are modeling only 4% earnings growth. For context, this is a fraction of the double-digit growth seen in previous expansion cycles, leaving the bar for a positive surprise incredibly low. If price-to-earnings multiples simply remain at their current levels, even this low-bar 4% forecast creates a mathematical path toward a 24% return. That gap between a cautious forecast and historical expansion levels is what creates the upside risk, leading to the strategist's target range of 7,700 to 7,900. The formula for navigating the AI era doesn't require perfectly timing the next Fed meeting. Instead, it requires tuning out the daily noise, staying the course, and letting the fundamentals do the work.